Our next section is operations management planning techniques, and we have module 1 on agenda tonight, projections and forecasting techniques part 1. What will we be covering in this specific module? Projection techniques, forecasting techniques, regression analysis, high-low method, and finally the learning curve. Now let us discuss first one, projection techniques. What are projections? Projections are multiple what ifs. There are multiple what if scenarios, differences that might occur in the future in different circumstances. So they are prepared for internal use, like what if the sales dip by 10%? What if the direct material cost goes up by 5%? What if the labor cost falls by 7%? So projections are multiple what ifs. What if scenarios and courses of action that a business might follow for the future. So normally they are prepared for internal use by the management accountants. So there are two types of projecting techniques we'll be discussing: sensitivity analysis and scenario analysis. Let us discuss these one by one. As I said that sensitivity analysis and scenario analysis, they are multiple what ifs. Let us discuss sensitivity. Let's say we want to calculate our net profit, estimate net profit of $100,000. Now, this is the profit figure, and we have different determinants that determine profit: direct material, direct labor, variable overheads, fixed overheads, variable selling and administration, fixed selling and administration, and of course your selling price and sales volume. They all affect your profitability, right? They all affect to some extent. Some are more influential, others are less. So the idea that let's say the sale price goes up by 10%, our profit will go up by 30%. But if the direct material cost goes up by 10%, your profit will fall by 50%. What does it tell us? That our net profit is more sensitive, more responsive to the changes in the direct material cost. So basically, sensitivity analysis is a process of experimenting with multiple what ifs. Different parameters can be changed and we can see the impact of those changes on our net profit. So it's also called the what if analysis. It's a risk management tool that is used to test the effect of specific variables like these and how they affect our profitability. Here is a good example. July sales for Besser Company are projected to be $100,000 with cost of goods sold of $60,000 and general and administrative expenses of $25,000. The CFO has determined that the variability in sales has the biggest impact on profitability. Means our profit is most sensitive on sales, and she wants to determine the effect on operating income if the sales dollars are over or underestimated by 25%. What if the sale goes up by 25% or falls by 25%? How would it affect our profitability? In order to estimate the changes in operating income, the CFO assumes that the cost of goods sold will consistently be 60% of sales, just like in this case. Sales 100,000 and 60% of it, 60,000 is your cost of goods sold. And it further says general and administrative expenses will stay constant at $25,000. Project operating income using the assumptions that sales at $100,000 are overestimated by 25%, correct or underestimated. So here is the solution. If they're correctly estimated, this is your sale, this is your cost of goods sold, this is your general and administrative expenses. So you expect $15,000 as operating income. If the sale is overestimated by 25%, so we have to lower it by 25%. That will be 75,000, 100,000 less 25% of 100,000. And the cost of goods sold, as the information told us, it is 60% of your sales, that is 45, and general and administrative expenses, they would be fixed. So operating income will be 5,000. What if the sale is underestimated and the right number should be 25% up? CGS will be 60% of sales and general and administrative expenses are fixed. So this is going to be your operating income. So you can see that if the sales go up and down, the profitability will be impacted this way. This is what you call sensitivity analysis. Next, scenario analysis. Scenario analysis is somewhat similar to the sensitivity analysis. Managers will prepare multiple different scenarios which represent alternative possible outcomes, and here we use probabilities in our estimation. So in preparing its budget for the coming year, Rich Company projects 3 scenarios for revenue: optimistic scenario, 30% likelihood, that is 5% sales growth; pessimistic, 20% likelihood, sale will fall by 5%, and the most likely scenario, which is 50% probable, no sales growth. So if sales in the previous fiscal year were 40 million, we need to project sales for the next year. So what we're going to do, you're going to take the weighted average, 30% of 5 plus 20% of 5 plus, remember it's negative 5, and 50% of 0, which is 0 of course, will give you a total overall of 0.5%. So if the previous period's sale was 40 million, you need to just grow it by 5%, 0.5%, and your expected sales is going to be $40.2 million, just increase of 0.5. So that's what you call the scenario analysis, where we prepare multiple scenarios with different alternative possible outcomes, and then accordingly we can project our future. Our next subtopic is forecasting techniques. What are forecasting techniques? What is forecasting analysis? Forecasting is basically driven by historical data. We will have a set of historical data, our sales data based upon different levels of advertisement, or may our sales data plotted against the time. So we will have our historical data, and we can use historical data to project the results for the future, right? So if our past sales is plotted against time, this is called the time series method. This is a projection method called the time series. But if we take advertisement on the x-axis and sales on the y-axis, now if you plot our sales historical data based upon the different levels of advertisement and sales, this is what you call the causal method. So these two methods, the time series and the causal method, they are called the quantitative methods, where we use numbers to predict. And there's another method called the qualitative method of projections, where we just use our experience, our business acumen, our opinions, judgments regarding the future. What is going to be the sales? We can get just a judgment and opinion from our senior management. So what we have learned so far is that what we did in previous subunit was projections. Projections are normally used internally. What we are doing now is forecasting. That is used for internal and external purpose. So we discussed that there are two types of forecasting techniques. One is qualitative, other is quantitative. So in qualitative, we just use opinions and judgments, and in quantitative, we have two further classification. One is the time series analysis, where we plot our data based upon time, and other one involves some cause and effect relationship, like when you spend more money on advertisement, your sale goes up. This method is called the causal method. So basically the purpose of forecasting analysis is predicting the future values of our sales based upon some variable like advertisement, or projecting our or forecasting our total cost of production based upon the number of units produced. So basically we want to predict the future values, and these future values are based upon some independent variable which will serve as an input, and this will help us determine the value of dependent variables. So we will discuss it in detail in our next subunit. Regression analysis is our next topic. Okay, now first of all, what is regression analysis? As we just briefly discussed in the previous subunit, regression analysis involves the prediction of the value of a dependent variable like our sales based upon an independent value of advertisement. What should we spend on advertisement that would give a certain level of sales, right? What should be the level of our production, and at that level what would be our total cost. So to predict the value of a dependent variable, given to use the certain values that we put for independent variables, establishment such a relationship is what you call the regression analysis. Regression analysis could be a simple linear regression analysis, or it could be a multiple one, like for example where we just want to determine our level of sales based upon our advertisement. So there is just one single variable, single independent variable that helps us to estimate the dependent variable, just single variable. This is called the simple linear regression model. But sometimes we may have to use more than one independent variables. We know for sure that sales is not totally dependent upon number of advertisement, dollar you spend, the dollar advertisement. Sales depends upon the number of sales staff. Yes, advertisement. level of competition in the industry in which you're operating, disposable income, economic growth rate, GDP growth rate. So there are many variables that can affect your sales level, not just a single variable like advertisement. So such a model where we take multiple independent variables is called the multiple regression model. You don't need to construct equation for multiple regression. You just need to be able to interpret and understand the concept and apply it in the given situation. But we will be required to construct a simple linear equation under the simple regression model and then use it in the given situation. So the point to note and remember here is that in simple regression model, we have just one independent variable, and in multiple regression, there are more than one independent variable. So let me show you. Okay, now this is your regression equation. Now let us give it a more practical form. Our sales is equal to a certain number, let's say 4.2 million plus 311 times x. Now listen, our sale is our dependent variable which we want to estimate, is equal to $4.2 million, which is our contractual sale, which will take place even if we spend nothing on advertisement. And for every $1 spent on advertisement, we generate $311 of sales revenue. So this is the simple linear regression equation where sale is estimated by plugging in the value for advertisement. So it can be mathematically plotted on a Cartesian coordinate system this way. This is the level of advertisement in dollars, and this is the level of your sales. So this point here, 4.2 million, this is the contractual sale which is not dependent upon your advertisement, but then every $1 you spend will generate an increase of sales of $311. So remember this part, let me highlight. This is the dependent variable, Y. This 4.2 million shown here on this system here, this is what you call the y-intercept, sometimes called the fixed component. It is represented as A here. It's called y-intercept, where the regression line cuts the y-axis. Then this is the variable coefficient represented here with B. B is the slope of the regression line. The steepiness of this line is called B. And then finally X is the independent variable that will serve as our input. The regressor, the independent variable, in our case is advertisement, that will help us estimate our sales. So how would our sale go up if we increase our level of advertisement? That's what we can use this equation for. Next, we have the statistical measures to evaluate the regression analysis. We have just discussed that if you have sales and advertisement and you have many pairs of data, when you spend $10,000, your sale was 12 million. When the advertisement was $15,000, your sale was, we will have many pair of data like this. Now, of course, they are correlated. Advertisement and sales, they are correlated. What is the strength of their relationship? The strength of their linear relationship is determined by a statistical measure called the coefficient of correlation, right? Coefficient of correlation can be between -1 and +1. It is range bound. It is greater than equal to -1, less than equal to +1, and it cannot be greater than 1 and less than -1, right? Now, what does it tell us? It tells us if the coefficient of correlation is +1, the two variables are perfectly correlated in a perfect straight line, perfect positive correlation, a strong correlation, I would say. And if the R is -1, that means the two variables are perfectly negatively correlated. If one goes up, other goes down. And if R is 0, it means there is no correlation, as you can see in this line. So if R is closer to +1 or -1, it becomes easier for us to predict the dependent variable using the independent variable. So coefficient of correlation, basically it measures the strength of the linear relationship between the independent variable and the dependent variable, right? And as I said, the range is between -1 to +1. Now, let's say R is not always perfectly -1 or +1. It could fall somewhere between, let's say my R is 0.90, right? It still shows positive 0.90. That means the two variables have strong positive correlation. Now there is another statistical measure called the coefficient of determination. If I take the square of this number, it will give me 0.81 or simply 81%, right? What does this tell me? This tells me, this is called the coefficient of determination. This tells me that, let's say if this is between sales and advertisement, what I can conclude from this? It tells me that if the sales varies, which is my dependent variable, 81% of the change is caused by advertisement. In other words, I can say the variation in the sales, 81% of this variation is explained by advertisement. Quite a good number. Let's say if R happens to be 0.60 and if R squared, it will become 0.36 or 36%. What it will say? It says that 36% variation in sales is explained by advertisement, by my independent variable. Right? So the closer it is to 1, the better. Remember, just like R is range bound between -1 to +1, R squared can have a value greater than equal to 0 and less than equal to +1. It can't be beyond this. Remember, the coefficient of determination is something you will find within these range. And closer it is to 1, we can say the stronger relationship, the better fit between the regression line, and more dependable the regression equation would be. Here is a good illustration. Based on looking at 5 years data on fixed cost and variable cost per unit, Regression Incorporated determined that fixed and variable cost in the next year will be 16,000 and 4.5 per unit, which means the equation can be written this way. 16,000 is the fixed cost, like the y-intercept, and 4.5 times x, that's the variable part. That is basically y is equal to a plus bx. Now, Regression has determined that the correlation coefficient between the independent and dependent variable, that is x and y, is 0.9. That is good. R squared for the regression equation is, of course, 81, 0.81 or 81%. Now, what it tells us, R squared of 81% or 0.81 means that 81% of the changes in y, the total cost, can be attributed to changes in volume, or the changes in y that occur, 81% changes are explained by changes in x. That's what we discussed previously. Now, next subunit we have is high-low method. High-low method. What is high-low method? It's a technique that we use to estimate the fixed and the variable portion of a cost. Of course, production cost. That's what you mean. If your total cost is equal to fixed cost plus variable cost per unit multiplied by the number of units produced. Right? So this is the equation we will be using, and how to determine fixed cost and the variable cost per unit. And this is the tool we will use to do just that, to determine the fixed cost and the variable cost. There are certain steps you need to follow. Gather data, analyze data, and formulate the results. So this is the data for the last 6 months. We have our units of production and we have our cost. So you can see this is not a fixed cost, and this is not a variable cost also, because variable cost on per unit basis stays the same. So if you divide 9,000 by 1 or 1200, 8450 by 1000, so the unit cost data will vary, which clearly means it's a mixed cost, and we need to separate this into its fixed component and the variable component. So following the steps, gather data, which we have, analyze data. You need to analyze the data for 2 things. Highest activity, that is the highest number of units produced, that is 1400 right here. That is the highest activity, and this is the cost at the highest activity. Call it the highest cost or the high cost. Then you need to identify the lowest activity. This is the lowest activity, and this is the cost at the lowest activity. Call it the right. Then apply this formula to determine B. What actually we are doing, we are trying to construct an equation that will split the fixed and variable cost and give us the result in this form. Y is equal to A plus BX, where Y is the total cost, A is the fixed cost, B is the variable cost per unit, and X is the number of units. So let us do that. So let us determine first B. B can be calculated using this formula, the highest cost minus lowest cost upon highest activity minus lowest activity. Why I am using the word activity, not units? Because you may have hours, machine hours, highest machine hours, lowest machine hours, labor hours. So it's appropriate to use this so as to not to confuse that you will always have units. Highest cost is 9550. And the lowest one is 8450. Highest activity is 1400 and the lowest one is 1000. If you solve this all, you should get your variable cost per unit, that is going to be $2.75. Now we have one element now, a plus bx. So in place of b, we can write 2.75x. Now listen to me very, 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 very carefully. Now you have to establish a. You cannot, you should not, you must not use any other pair of data than these two highlighted. Highest and the lowest. High and low, nothing else. Right? So, in order to establish or determine A, you can either plug 1000 for X and 8450 for Y. You can find A simply. Solve this for A. Y will be 8450 the cost and X will be 1000. Alternatively, you can use 1400 this activity pair, 1400 for X and 9550 for Y. Whichever you take, whichever of these two pairs you take, your A will definitely be 5700. You can try this. Now we have our equation. Y is equal to 5700 plus 2.75x. 2.75x. Now, Y here will be total cost. 5700 is your fixed cost. 2.75 is the variable cost per unit, and X here represents the number of units. Now the question that you might ask me, why do we have to take cost as independent and volume and unit as independent? Because the reason is your volume is determining your cost. If the volume is more, the cost is more. The volume is less, the cost is less. If the volume is nil, you just pay the fixed cost, right? That is why you need to identify which of these is independent. Volume, the units of production are independent. They determine the cost. So that's why we take cost as dependent and the volume or the units of production is independent. Okay, now we got the understanding. Next concept, a slight discussion on flexible budgeting. Let me tell you. Let's say we prepare a budget of 10,000 units for the year 2022. But in reality, what happens? Your budget is overstated. Your actual production in 2022 was 8,000, or your actual production was 11,000, or your actual production could be 15,000 units. Now what to do? This original budget is called the static budget, SB static budget. Production can be less, more, or even more. So we may have to revise our static budget into a new budget based upon 8,000 units of production and sales, 11,000 units of production and sale, 15,000 units of production and sales. So changing the original budget based upon different levels of activity is called flexing the budget, and these budgets are called the flexible budgets. Don't worry, it was just the idea given in the text, so we have discussed it here. We'll discuss it in detail in its specific position in the topic budgeting. And that completes your subunit high-low method. The next one we have is a very fascinating concept called learning curve. So what is learning curve? Learning curve basically is based on the assumption that workers become more familiar with the task when they keep on doing it again and again and again and again. So it means if you keep on doing a task repetitively, every time you do it, you will take less time than the time you took previously, right? So this is very useful for us management accountants. We can use this concept to establish our standards, to estimate our project's costs, right? Now let's take this example from here. You produced the first unit and it took you 100 hours, let's say. When the task was done again, or when the two tasks were performed, the average time fell to 80. When the output was doubled to 4, it fell to 64. So as you can see, as the task is being performed repetitively, the time taken will be progressively shorter than the time you took in the previous level of production. This is called learning curve. Good thing is that in most of the questions you will be given the learning curve percentage, but if you may be required to calculate it, it's not very difficult. Let me show you how you can find the percentage, how you can solve the question. There is a suggested method that you should use. Let me draw it up here. This will work. Every single question, whether it's from CMA or CPA or CIA or whichever American certification, if it involves learning curve, follow my method. You will draw three columns. First would be for the units. Second column will be for the total time or sometimes total labor cost. And the last column will be the average time or the average labor cost. Remember, learning curve is applicable on labor only in the CPA context. We are not talking about machine learning or artificial intelligence. We are talking about the labor learning, the learning by human beings. So remember these three columns: units, total time, total labor cost, average time, average labor cost. Let's take some examples. Like, let's say we prepared or manufactured first unit. It took us 50 hours. What would be average? 50 by 1, 50. When the output was doubled, our time should double to 100. But since we are on learning curve, and the learning curve percentage is given to us, let's say it's 80%. So the time taken would be 80% of 100, that is 80. Average will be 80 by 2, 40. When the output is doubled from 2 to 4, the time taken should double from 80 to 160. But since we are on 80% learning curve, our time taken would be 80% of 160, that is 128. 128 divided by 4 is going to be 32. And from 4 to 8, you can follow the same process. Now, why I have just used the doubling of output, 1 to 2, 2 to 4, 4 to 8, 8 to 16. You will always be tested when the output is doubled. You will not be required to calculate the time taken by the 6th unit, for example. Just the doubling of output, remember. So this table will go a long way. You can solve every possible question of learning curve in CPA using this tabulated approach. Now, sometimes you are required just to calculate the average time or the average labor cost. In that case, just take the last column only. Let's say we don't have these numbers. First unit took 50 hours. What would be the average time when 2 units are completed? Simply 80% of 50, which is 40. When the output is doubled from 2 to 4, what is the average cumulative average time when 4 units are completed? So 40 is 80%, 32. So you can find out the last column yourself in a quick way that I've just told you. So you can solve any question on your exam or in any software using this approach. It has worked. We have solved hundreds of questions using this tabulated method. Any intermediate step, any intermediate working that the question might require, you can find it out using this approach. Thank you. Okay, now we have a question. It takes the John's production company 50 hours to produce the first unit of its only product. Assuming 70% learning curve, estimate the average time and the total time to produce 2, 4, and 8 units. I told you, you need these three columns: units, total time, average time. It will be very convenient for you. When first, second, and fourth, and 8th units are produced, the total time first was 50. When the output was doubled, your time should double to 50 to 100, but we are on learning curve. 70% learning curve, 70% of 100 is going to be 70. When the output is doubled from 2 to 4, the time should double to 140, but since we are on learning curves, it's going to be 140, 70%, 98. Output is doubled from 4 to 8. The time should double from 98 to 196, but it will be 70% of 196, so it's going to be 137.2. The last column can be quickly calculated without reference to these. When the output is doubled from 1 to 2, the average time will be 70% of 50, that's 35. The output is doubled from 2 to 4, the average time should be 70% of 35, that is 24.5. And when the output is doubled from 4 to 8, the average time will be 70% of 24.5, that is 17.15. If you just want to check, divide 137.2 with 8 and you will get the exact 17.15 hours as your average cumulative time. So whatever is asked, we have given it there. Most of the questions will involve the percentage already given to you, the learning curve percentage, but you may be required to calculate, but it's not difficult. It takes the John's production company 50 hours to produce the first unit and 70 total hours to produce the first 2 units. So you can see here, it will help. Units, total time. First unit produced took 50. When the 2 units were produced, the total time was 70. Just look at this. When the output was doubled from 1 to 2, your time should have doubled to 100. But instead, you just used 70 hours. 70 is what percent of the time that you should have used? 70%. So the learning curve percentage is 70%. It takes John's production company 50 hours to produce the first unit and 35 hours on average to produce each of the first two units. Calculate the learning curve rate. Again, units, total time is not involved here, average time is here. So first unit took us an average time of 50. Two units together took an average time of 35. 35 is what percentage of 50? 35 by 50 times 100. Again, it's 70%. So learning curve is 70%. So that completes your module 1, projection and forecasting techniques part 1.